This is a pretty cool book. It's called Rule Number One by Phil Town. Phil Town is self-described tour guide, adventure tour guide. He was teaching whitewater rafting. Anyway, he did that. He saved this guy's life, he says, and the guy taught him rule number one, which is how to invest. So back then, his rule number one comes from Warren Buffett. Warren Buffett has a quote. He says, rule number one is don't lose money. Rule number two is refer back to rule number one. So in order to invest and not lose money, according to this book, I'm not telling you to do any of this stuff. I'm just telling you what's in the book, by the way. Okay, there's your disclaimer right there. Phil Town suggests that you invest in the stock market, and he gives you a strategy on how to do that. And basically, you know, you might think that this is all about the stock market, but basically, the basic tenet in this book is he doesn't care what you buy. Buy it for 50% off. If you buy it for 50% off, that's what he calls a margin of safety. And that margin of safety will prevent any errors in your calculations on, you know, what the original price or value of the item is that you bought, so that you'll be able to sell it at a profit and make about, his target is 15% a year. He says if you can make 15% of your profit a year, you should be able to live on that pretty comfortably, and you'll get rich in no time. So, and he says it only takes 15 minutes a week. Now, what he means by that is that once you get all your research done, you only have to check on whatever stocks you pick, and he's basically an eggs in one basket kind of guy. He says that you research one company, find that perfect company, and go ahead and put your money in that, and then watch that stock every day. You can do your checkups for 15 minutes. So he has a strategy for that. So his strategy basically is that you pick a stock that you know something about. So let's say, in his case, he liked to ride Harley Davidson. So he would do research on the Harley Davidson company. So his idea was that had meaning. He uses these M's, meaning. And then the second thing was he looked into the management. And management, he would read like the letters that the management would put out to stockholders, and he would try to see if there was double talk, or if there was any reason, there was some reason they didn't make enough profit, or what the goals of the company are. Try to read the psychology of the management, and hopefully you've got good management. He doesn't really get into great details about how to do that, but the third M was, is there a moat around the company? And Warren Buffett uses this idea of a moat. Is it a brand name that like everybody identifies with? Of course, Harley Davidson is, because if you're going to buy a motorcycle, I don't know, is Harley Davidson the best motorcycle made out there? Maybe, maybe not, but everybody knows the name. So they've got the brand. Coca-Cola is another one. There's just certain brands that everybody knows. That's a brand moat. There are other types of moats too, and he talks about those in here at length, so you can kind of like read the book and get an idea of what those are. He also talks about different factors. Once you pick a company, there are 5 indicators that you want to see going up over the last 10 years. And those are numbers that you can get online, and he tells you where to do that. This book was written in 2005, by the way, so a lot of this stuff is a lot of this information is easier to get, and a lot of it's in different formats than he talks about in this book. And I'll talk about the anachronistic aspect of that writing in 2005 in a second. But when he says there are 5 indicators, economic indicators you want to do to research your company, he's talking about return on investment income. You want to see that going up over time by at least double digits. All of these by double digits over time. 1 year, 5 years, and 10 years spans. And so return on investment income, revenue, just gross revenue, sales, EPS growth, earnings per share growth over time, and then he talks about book value per share, which he calls equity, and then cash flow. So there are some exceptions, but generally you want to see all those increasing over time. And then you got a solid company. It's probably going to be around for the next 10 years. Also, he wants companies you can find information on for 10 years. So these companies have been around for at least 10 years. So he's not talking about buying startups and getting rich quick. This is a very gradual, over time, kind of like steady, safe strategy. So just so you know that. He's talking about making 15% a year or doubling your money basically every 10 years. So he's looking at 15% return. And he has a calculator online at his website, rule number 1, investing, I think it's called, .com. So that's written in the book too, and you can find it by doing a quick internet search. And he does actually have calculators that are free, although they use cookies to track your information. So you gotta want to, like, use those if you want to. Or he shows you the long way of doing the formulas too, to get to basically a margin of safety price is what he's talking about. So in order to get to a margin of safety price, which is 50% less than whatever you're buying is worth, and in this case it's stocks, how do you find out what a stock is worth? And so that's basically, he calls that in this book the sticker price, as if you're buying a car. But in the real financial world, they call it intrinsic value. And there are many ways to find out what an intrinsic value is. There's different ways to do that. He uses one way, and he talks about that formula in here. And in fact, his website also has a way for you to put those numbers in and arrive at that formula. And once you arrive at that formula, you divide that in half, and you wait for that price to happen, because according to him, the stock market acts erratically with emotion, and sometimes it doesn't make sense, but stocks that should be valued up here are valued down here, and that's where you want to buy them. So it's basically a buy low, sell high kind of strategy, which makes perfect sense. So that's great. So let's quit our jobs and get rich, right? Well, the only problem is that I read this book in 2019, and now it's 2020, and stocks are nowhere near their intrinsic values at this point. Almost all stocks are way overvalued. And even with the recent pullback in the last 2 weeks, this strategy is wonderful, but it's not really working right now. Like there's no way to apply it right now. In fact, if you go to his YouTube channel and listen to his videos, he'll tell you he's holding his money out of the market right now. So this might be a great book to read in order to get investment strategies for a bear market situation, a market where like prices are lower and you're searching for good companies in a tough market. And I think there's a lot of wisdom in this book. I think it was very well written and pretty clear. Although his intrinsic value section, I had to reread that a couple times, and I'm still not quite sure I got it down. But he does have a calculator online in order to help you with the actual numbers. I think it could have been clearer, but on the whole, his concept of buying low and selling high and how to do that is pretty encouraging. The problem is the stock market is severely overvalued right now, like historically overvalued. And this strategy is going to be really hard to implement. So, but what I really like about it is his idea of buying companies that have been around for a long time and are exhibiting growth over long periods of time. That's a great way to sort out the kind of risky investments. One that I was just talking to somebody about the other day was Tesla. I'm not picking on Tesla. I like Tesla. I think they're doing great things. Problem is they haven't shown any profit over, I think, 1 quarter they showed profit. They haven't shown any year-to-year profit ever, but their stock goes up and down wildly. It would be really hard to when you're looking at a company that has a negative EPS, negative earnings per share, he basically says don't buy it. You want a positive EPS. So when you're looking at companies like that, it's speculating. It's not investing. And there's a difference. Okay. So speculating is like running through a dynamite factory with a lit match and not getting blown up. You might have made it, but you're still an idiot. So I forget where I heard that quote. I love that quote. So I don't think it's in this book. But yeah, so anyway, it's a book worth reading. There's no doubt about that. Whether you're going to be able to apply it in 2020, who knows? I mean, if the coronavirus makes the stock market collapse, yeah, at some point you might be able to find stocks at their actual intrinsic value. But until that happens, I don't know. in the meantime, it's good to accumulate knowledge. It's great to read books. That's what this book is about. I liked it. I thought it was well written. If I read it in 2005, I might be retired today, but I'm not. So, all right, thanks for watching. Please subscribe to the channel. That way someday maybe I can retire off of my YouTube income, which is 0 right now. But with your help, maybe we can change that. And if you have any comments, please put them below. And thanks for watching. Take care.